welcome to the Monday Futures Market Outlook for June 6, 2011. This is Patrick Ceresna. For those that have not had the opportunity to try out the eminisource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that the market has gone through. We bullishly crossed that back in late 2009 and subsequently have stayed above that line since. We've been looking more or less for the move on the upside to have come to an end and now begin some form of a market consolidation correction on the downside. It does not necessarily have to become a bear market. It's simply the normal ebb and flow of the markets. If we have a good consolidation down towards 1200, 1220, 1240 on the downside over a couple months and good basing, that may be the extent of the selling and subsequently will emerge as being a significant buying opportunity. But we'll reserve our right to make a call on that as we see the market price action develop over the next few months. Let's talk about some of the key market observations that we want to observe. First of all, we've ever since we crossed that 80-week moving average, we've had a relatively intermediate bullish bias on the markets, but we have reached the upside targets for the year of what we forecasted, and so therefore it's an increasing probability that we have seen the highs of the second quarter, and there is even a chance that it might be the highs of the year, but it's again too early to substantiate that kind of a statement. We were anticipating that market top to come in somewhere at 1350, 1380. What we're basing a lot of that intermarket analysis shift on was the fact that the U.S. dollar was going to at some point start some sort of a rally, and we definitely got that a few weeks ago as the market pushed. But over the last week, we've seen significant deterioration in the U.S. dollar again, even below what were our natural retracement zones. This muddles or fogs the asset class rotation we've been looking for from an intermarket perspective. This sort of puts a muddle on commodities and a number of other things that we felt were going to be strongly correcting during this time frame. But let's take a look at some of the individual charts and see what exactly I mean by that. When we take a look at that S&P 500 on the daily charts, you can see that we got reversed right off that 1340 area that we marked off last week. And really at this point began a correction lower at this stage. There's 1290 and there's another spot around the 1280 area down below that finished what we call measured moves lower. Now there's one of two scenarios at this line. You can see that this is where the lows came in April, and really at this stage either the bulls are going to hold this line and we're going to get a full retracement back up to the 1320 area on the upside, or there's always the chance here that if this line is broken and we get any accelerated selling, we could find ourselves very quickly down at 1250, 1260 on the downside along those previous lows and testing those support lines. So it'll be very interesting early on this week whether the bulls can actually hold this line in this blue box and bounce the market or not. Next year, I want to take a look at the U.S. dollar, and you can see that on the futures in the U.S. dollar, we had substantial weakness. We marked off that blue box where we were looking for the U.S. dollar to find some support if it was really just a retracing move on a rally. At this point, the best case scenario in the dollar is just simply a double bottom retest of that 73, 73.50 area before it starts to rally again. One way or another, if this in any way begins a new leg lower in the dollar index, particularly driven by that jobs number and other things like that. If the dollar index breaks these lows and really accelerates lower, it will certainly stall much of the selling we've seen in commodities, and then and potentially even strengthen the market. So as this dollar makes these moves here, it's going to have a significant ripple effect on all of our analysis that we've been forecasting up until now. Next year, let's take a look at copper futures, and this really is a chart that reflects exactly what I've been talking about on that dollar. This entire rally that's been going on for the month of May into June here really looks like one little rising flagging wedge that could roll over and very quickly go down to the even 360, 370, 380 area down below. But if that US dollar in any way deteriorates, then there's nothing stopping copper from still making further advancements on the upside. We're going to be watching very carefully how that relationship with the dollar works out here, but it would take at this point a break below the 400 level on the downside of copper to really open that window to the downside. Next year, we'll take a look at gold futures, and gold continues to dig in and hold this rising trend that it's had for the last 2-3 weeks. This is primarily driven by that US dollar weakness. What we're trying to observe here is what exactly gold has in store depending on how the US dollar plays out. If the US dollar creates a double bottom on the downside, it's quite possible that gold will come up here for a double top retest, go one more time up into the zone, and then roll over from there. But under the circumstances, if there is a complete breakdown of the US dollar to new lows, maybe down to 72 or 71 on the downside, we actually have to start considering gold bullish at that moment. So a lot of what happens here will hinge on what's in store for the US dollar. Next year, I want to take a look at silver futures, and silver had a very dramatic reversal on the downside and subsequently has been flagging higher, marked off that retracement zone within the 38 to 42 area on the upside. With us having this little pullback, if that US dollar continues to weaken, we can't rule out that the silver still has one more full push back up into this 40-42 area on the upside before it has another reversal back down into these zones. And again, what muddles this scenario is again that U.S. dollar weakness. Under the circumstances from which silver would have a very healthy consolidation would be on U.S. dollar strength, and if we're not seeing that, we have to consider the scenario that silver still has one more push back upwards to before it rolls over. Next year, I want to take a look at crude oil futures, and again, crude oil looks almost identical to the charts on copper, on the charts on silver, and all those other ones. We have these flagging formations that are coming right into the retracement zones. Very naturally, crude oil could just reverse and break down, testing even as low as $85 to $93 on the downside of crude oil, but under the circumstances, if again we see extended U.S. dollar weakness, we can't rule out the possibility that crude will still come back to retest 105, 106 in the upcoming week or two while the U.S. dollar weakness persists before there's any breakdown. In order for this crude oil breakdown to occur and right off of this break, we would want to see a break below that 96, 97 zone on the downside, and also that accompanying U.S. dollar strength. Finally, I want to take a look at that 30-year Treasury bond, and we've been looking for 30-year Treasury bonds to take one little step back at some point here. We're not necessarily bearish on Treasury bonds at this juncture, but a pullback down to the 122 handle on the downside seems like a pretty reasonable expectation. So you can see that Treasury bonds overall are getting relatively top-heavy here. Anything that starts to roll over here on the downside could very quickly find itself down a couple points. That was your Monday Futures Market Outlook. Thank you for joining me.